All right, welcome everybody. I have a celebrity joining me to my podcast today, David Akre, who is well known in the banking and finance circles. I personally follow him on LinkedIn. Great analysis of DSCR, non-QM mortgage markets. We're going to touch on that, what it means for everybody in the banking and mortgage community. A little background on David. He's an architect and co-founder and co-CEO of NASDAQ-listed New York Mortgage Trust, NYMT. He took the company through great financial crisis and set up purchase and securitization programs for REITs, including New York Mortgage Trust, Thornburg Mortgage, and others. Sold and purchased over 20 billion residential loans. David is running the trade desk for both whole loan trading as well as non-QM. Welcome to the podcast, David.
Thank you. Thank you, Alex. Thanks very much.
My pleasure. All right, so tons of stuff to cover. Let's start with, I guess, basic definition, David. What's non-QM? I think everybody in my audience should know what it is. And let's just touch on the market, why it's important to talk about it today, why it became popular, and why this market is growing so much.
Yeah, I think the reason it's growing so much is because generic mortgage bankers are struggling to make money. Many of them are doing closed-end seconds and HELOCs. They started doing that a couple of years ago after rates started going up in 22 rather. So it was just another way to add income to the bottom line. And then non-QM is just another way to do it. I think there's more money to be made in non-QM than there is in closed-end seconds or HELOCs. So everybody that started maybe with closed-end seconds is pushing into non-QM because it's a nice market. There's plenty of liquidity. The gain on sale margins are much, much better than the agency loans, which basically are, non-existent. And the closed-end seconds and HELOCs are so small. The loans are so small. Even if you make a couple of points, it doesn't add up to anything significant. So average loan in non-QM is about $500,000, and you can make, whatever. Depending on where you are in the food chain, you can make, you can make a couple of points, or it's a significant amount of dollars. Put it that way. So everyone's kind of forced into it.
Yeah, so David, let's just start with the definition first, right? So QM means qualifying mortgage, right? Non-QM, not qualifying mortgage. So from my basic understanding, QM mortgages have 20% down sort of down payments amount, and non-QM is less than 20%, or it has some sort of a oddball assets which do not qualify for securitization of the mortgage within agency, Fannie and Freddie. Is that pretty much accurate, or how would you define it?
I mean, there's been a definitional change from CFPB a couple of years ago. It started off as like ability to repay focused, and now it's more rate focused. But basically, non-QM are bank statement loans and debt service coverage loans. Those are the two biggest pieces of it. And there's some there's other pieces as well, but it boils down to doc types. Interest only loans are still non-QM by definition in CFPB world, but essentially it's bank statement. Think about it as bank statement and debt service coverage loans, P&Ls, maybe asset depletion. There's a couple other varieties, but that's essentially what it is.
Okay. So with the market dynamic of rates going higher and the salaries are not growing as much, as well as there's an issue with affordability, a lot of folks are not qualified for the regular QM mortgages, and they're sort of forced in the bucket of non-QM, which allows growing number of lenders to underwrite a loan with, like you said, bank statements or assets or business purpose loans, etc. Is that what causes the growth of this particular market, or there's other dynamics?
I think primarily it's just loan officers on the street or mortgage brokers, which are the primary originators of non-QM or mortgage brokers, they're just working harder. So if you go in and you find a borrower that needs a loan, 2-3 years ago, you could offer A, B, or C. Now you have 3 or 4 different additional options, because non-QM. So for another reason is DTI is over 50. So if, Fannie, Freddie, if you go over 50, it's coming back to you. It's like a boomerang. It's definitely coming back. Even, they'll underwrite the loan 6 months later and just figure out a way to get it back to you. But in non-QM, you can go up to, 50, 55 without a problem. So I think it's just people working harder and trying to find those borrowers. The borrowers, self-employed borrowers are a significant part of the demographic, and they always have difficulty. Historically, have always had a very difficult time getting loans. So now with bank statements, and if you're buying a house, um, you know, going through debt service coverage loans are a lot easier to get, in the non-QM channel than going to Fannie Mae. So I think it's just a, broadening of product and people working harder to find the borrowers.
So really what you're saying is this segment growth is it allows for more percentage of the borrowers to be qualified for DSCR or non-QM, right?
Yeah, yeah, true.
And what's the rate difference between the agency versus non-QM? Is it equivalent or
Yeah,
non-QM is
75,
typically
I want
higher?
to say 75 basis points higher.
Okay. So now there's also an incentive for the mortgage broker to pitch the borrower non-QM because their commission is based on the rate as well, right?
No, no, that's gone away with, that after the financial crisis, you can't get paid more for delivering a higher rate. So, it's just a question of getting the loan approved and getting it closed. So you can get it, if it's a no-go with an agency loan, you can go non-QM, and chances are 50/50 or whatever that you're gonna get the loan approved and get it closed.
Okay. So really it's a reduction of compliance, qualification, it's higher rate for the lender, and I think there's more people to qualify is the other growth factors for that market, right?
Yeah. Yeah.
Okay. And also I think foreign individuals can qualify, if I'm not
Yeah,
mistaken.
there's a decent amount, probably in non-QM issuance, there's probably 2 to 3% are foreign nationals, and then there's probably another 4%, non-permanent resident aliens. So that's in certain markets in Miami, that's a big part of the market, right?
Absolutely.
So in Boca, right, where you down in Boca, it's a big part of the market. I think, we'll see if that continues, but, it's always, it's 5, 6, 7% of non-QM deals are either foreign nationals or non-permanent resident aliens.
Understood. So uh, a few years ago, right, when the rates were still low, um, I was talking to a few friends of mine in the mortgage and banking industry, and you only had a few players in the non-QM space, such as A&D Mortgage, friends of mine, Max and Victor, right?
Yes.
The New Res folks with their acquisition of what is it, New Pen, I think, right? And then a few others. And now it looks like the market is flooded with lenders. And I love your table here. If I can show it in front of my audience, maybe let's touch on who is playing in that market.
One thing we didn't talk about in definitionally is, what else I'm throwing into the mix here in terms of including in this, I've kind of broadened the discussion into more non-agency. So the additional piece, and by the way, some people issued just debt service coverage ratio loans only. Usually DSCR loans are about 30%, 35% of non-QM deals. Um, every once in a while, somebody will issue a deal just with debt service coverage loans. So sometimes people leave those out and they look at the totals. But the other interesting part are agency eligible loans that are made to non-owner investment properties and second homes. So Fannie and Freddie have killed those things in terms of G fees and LLPAs. The G fees are high to begin with, right? Ever since the financial crisis, the G fees have gone up significantly. They're around 50, 55 basis points now, which is how Fannie and Freddie are paying the Treasury back so much. But in addition to that, there are massive LLPAs, right? Loan level price adjustments on non-owner and second homes to the extent that people like Penny Mac and others are able to buy those loans that are fully Fannie eligible loans and put them into their own deals and make a nice return on the equity piece. So I've included that in the table that you're going to show.
I'll just read through a top five, I guess. So Annaly, the largest player on the non-QM volume, Varus,
Right.
Angela Gordon, which was really surprising. They pivot from student loans and from the NPL RPL business. Morgan Stanley, which plays both in non-QM DSCR, Angela Oak, cross country, PIMCO, also very surprising pivot, and of course JP Morgan and Chase in non-QM and DSCR, right? So a lot of, and then just going through the list, it's Penny Mac, it's Caliber, it's Ellington, Santander, New Res, my buddies at A&D, and Bullback, also my very big client, Goldman Sachs, etc. So all the folks that used to be in the RPL NPL space, they're now, for the lack of products, right, on the market, as probably you can comment on the trade desk sort of availability on what's coming across. They're all rushing into non-QM market, right? And they're now, I'd say, pretty crowded market, which, if you're not playing on with the big numbers, if you don't have a large enough volume, why even go there, right? So is there anything in that table, and I'll share it with my audience after we post this the podcast on the YouTube. Is there anything that stands out to you on this list?
I mean, new folks in the market, Penny Mac's been doing the agency eligible loans for now a couple of years. Santander's new, New Res is new. Provident Funding is doing agency eligible. They're fairly new at that.
I'm surprised. Yeah, so I'm surprised with PIMCO pivot to non-QM.
Yeah, but they've been buying these loans for a long time. I know for a fact that they way back when non-QM got started with 2011, 2012. When in 2009, 2010 or 11, non-performing loans, and there were billions and billions of them, were trading at 50 cents on the dollar, 45, 50 cents on the dollar. A lot of people that were in the game switched over to the non-performing side and they loaded the boat. And then by 2012, the early adopters were getting out of that trade and going into non-QM. And Citadel, which is now Akre, is one of the early adopters of non-QM. But they've only done one issue. They are now owned by HPS, right? HPS is a large asset manager that bought Akre, and then HPS is being purchased by BlackRock or Blackstone.
All roads.
BlackRock is buying HPS, so the old guys, yeah.
All roads lead to BlackRock or Blackstone.
Exactly, yeah. But the Apollo has decided early on, and talked about this a year ago, where if you're not vertically integrated as an asset manager, in other words, if you don't have the ability to create the asset and then manage it in a separate vehicle, you're always going to be bidding against somebody else for the asset. So that was actually the same thought process that went into New York Mortgage Trust, because we were the only REIT at the time that owned an originator. Everybody else would just compete to buy pools. We had our own platform to originate the loans, which turned out to be an albatross when the financial crisis hit. But these days it's back to that, whereas all the asset managers are scrambling to get underneath them an origination vehicle. So anyway, so BlackRock is buying HPS, which owns Akre, but Akre has only done one issuance, so it kind of surprises me. But I think they've got now. This will lead into a conversation later on. Insurance money is coming into the marketplace, into non-QM marketplace, or into the whole loan marketplace. Not agency, whole loan marketplace, and so all of the big asset managers now have an insurance component. They're going out and buying reinsurance contracts, or they're writing insurance themselves, but somehow they're all in the insurance game now, and they want to put loans on the balance sheet against those liabilities because it's a good long-term duration asset that they can use to matches up pretty well. So anyway, I think that's the main reason that that Acra's not issuing. My guess is that they've got, I know they've had a very long-term relationship with PIMCO,
Yeah.
and PIMCO is obviously a very, very large asset manager that also manages insurance money. So anyway, so other than that, there's nothing. I think Ares is fairly new in the space as well. Angel Oak's been around for a long time. Morgan Stanley is, they're a newer broker dealer into the space. And Verus and Annaly, Verus has been around probably longer than Annaly actively. They've slept because Annaly is they're in the 13th deal for the year right now. The 13th deal is out in the marketplace, so their hair must be on fire every day. I can't imagine the volume going through that place is just incredible. It's just nuts.
Yeah. I noticed that as well. I spoke with those guys at the MSR conference in Dallas. Same thing. They went through the segments. They're trying to really be on the top of every market they play with. Now, you segments the AUS, DSCR, and non-QM as separate categories. Let's go through the definitions first. How do you segment in those three? You show that PennyMac is only playing in AUS markets, while somebody like there's no good example. Everybody else are either pure non-QM or non-QM plus DSCR. By the way, A&D mortgage is also DSCR as well as non-QM. But how do you segment that under the umbrella of non-QM?
Well, certain people like JP and Morgan Stanley and Ellington, they will do deals with just business purpose loans. So the debt service or just business purpose. So from a compliance standpoint, they're easier to deal with because there's no borrower facing. There's no consumer. It's not a consumer loan. It's a business purpose loan. So some people like insurance companies, especially some insurance companies, do not want to have any consumer risk. So they focus on just business purpose, and they tend to focus on just debt service. So some people just, at JP's very, very busy. They buy regular non-QM and buy just debt service and put it into segmented deals. But by and large, if you look at the non-QM, if I broke out all those non-QM deals, it's probably 30 to 35% of those would contain debt service coverage loans.
Sure.
Average non-QM deals like a third debt service, and one third bank statement, and then a smattering of other stuff.
Okay, and then AUS, what makes it unique?
Yeah, well, I think PennyMac, Provident Funding, and Bayview. For whatever reason, actually, I talked to a guy this morning. A lot of what they bought last year, an insurance company, a lot of what they bought last year was AUS. It's to a certain extent, those loans are going through either LP or DU. So in other words, Fannie Mae and Freddie Mac. Fannie Mae's got an automated underwriting system that they've had for a long time called DU, and Freddie Mac's got LP. I believe LPDU. So you can run a loan through those systems, and it'll tell you based on, they've been mining data for you to use for these systems for I'm going to say 10 years or more. They will tell you what sort of documentation you need in order to get the loan, approved.
Agency approved, yeah. Mm-hmm.
Agency approved. So you could say if you're a risk taker, if you want to put these loans on your balance sheet, you have it's possible, a good argument could be made that you have less risk owning those loans versus a non-QM loan. Because, there are some automated systems and there's more and more now all the time for non-QM. And for debt service, there's certainly an initiative by a couple of big firms to roll out AI, automated underwriting for non-QM. But the AUS stuff's been around for such a long time that, there's people that they just play in that space. And again, it kind of goes back to the fact that the G fees are so high, and the LLPAs just destroy those loans. So it creates an opportunity for people to put those loans into separate deals, like PayMac. That's all they do. They're doing that through correspondent, the non-owner occupied agency eligible loans. And anyone that's originating a decent amount of non-owner loans and selling them to Fannie Mae, you're leaving money on the table, I can tell you right now, because you can probably get a better bid from Fannie Mae.
Would they go through your platform? Is that where you play?
No, just call up your Fannie Mae rep.
And sell it direct. Yeah, understood. So that puts a lot of color on the whole market. Now, for folks that are regular investors or funds or retirement sort of funds as well, they can invest into the securitization entities or funds on the market, right? So they just have to watch for Penny Mac or Morgan Stanley or Annaly funds to play in that market, right? For
retail investors, I don't know that there's a great way to. If there is one, I don't know what it is, to be honest with you. But if you're
MFA, maybe so investing in the stock of MFA.
Well, yeah, certainly. If you look at the dividend yield on Annaly stock is about 15%.
Okay, wow.
There's another mortgage REIT. The ticker is AGNC, and I believe they pay monthly, and it's about 15%. The mortgage REITs are all paying very healthy dividends at the moment. So, ostensibly, if you buy Annaly stock and you're getting that dividend, you are, the generation of that dividend is coming, probably 50% of that is coming from the non-QM issuance strategy, right? They've got other strategies as well, but maybe in their case, maybe it's 60%, but it's a significant part of Annaly's business is non-QM. And Ellington's the same way. Ellington actually has two REITs, and they both pay very healthy dividends. MFA, MFA is kind of sleepy. I know those guys very well, but they're a little sleepy. They don't know, whatever. So I don't know that much about what they're up to. And A&D's they've got funds. I know that some guys solicited me for investing in one of their funds, so they've got funds for retail investors. But
I mean, they got backed by Atlas Merchant, right? So Bob Diamond came in and pumped a lot of money into them, which is great. I actually was at the call it the ceremony of Atlas,
Florida?
Yeah, in Florida, ceremony of Atlas presenting on how they invested into A&D, and they're a strong believer in their tech, etc. So
they're smart guys.
Yeah. Oh yeah, absolutely. But I got to call up Brian at MFA and figure out what's his strategy on moving forward. But again, I think there's a way to play for the retail and fund investor. Now, from the folks that are in sort of a mortgage or brokers, they should. How would they play in that market?
What, mortgage brokers?
Yeah.
I mean, they're the main originators of non-QM are mortgage brokers. It's probably 85% of the originations in non-QM comes from mortgage brokers. So little guys, right? Little shops, one, 2-man operations, 5-man, whatever. Small mortgage broker operations that they source the borrower and they give the loan to, anybody on this list, most of the people on that list, and that person on the list will fund the loan. So, which is what Sprout was. Sprout was about 100% wholesale. probably 95% wholesale before it closed up. But, if you I'm looking at the list again. Angel Oak does wholesale. Morgan Stanley doesn't. Annaly does. Verus does. Angelo Gordon, I believe they do. Cross Country does. Most of the people on there do. Some just do correspondent, but most of them will fund wholesale loans. So the mortgage brokers, with every single active issuer has got AEs that call on mortgage brokers to source the loans. So
Okay.
they'll probably get, any mortgage brokers probably getting a number of calls from different issuers, the AE reps.
Do you think that UWM or Rocket will ever play in this market?
I think I believe I don't really follow them back to
Yeah.
that.
I mean, they're number 1 and 2 on the retail side, right? So,
Yeah, they're kind of crazy if they don't, because if you're spending X numbers of dollars per year to get the phone to ring, why wouldn't you want to convert another 10% of those phone calls into business? So you're kind of crazy if you don't. But,
yeah.
I think there's still, since the financial crisis, people still are reluctant. Look at the rating agencies. We could talk about those in a minute too, and what their view is of non-QM. It's pretty bleak. So I think if you are a large organization or large retail organization, you don't want to ever have any involvement with any kind of problem down the road. And for that reason, if you've got a lot of lawyers on the board, they're going to say, you're not going to do these loans because, you're going to get sued and blah, 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 blah. So maybe that's a reason that they don't, because I guess they're making enough money doing agency business. They don't want to dip their toe potentially into a place that could come back and bite them.
Yeah, if I'm a businessman, I would invest on in their place, because, like you said, they're losing, they're losing money.
Yeah.
If somebody's not qualified, do you drop them? No, you should probably hand off to a non-QM departments, or maybe they have a channel where they have an agreement with one of those players
Yeah, maybe.
to, yeah, to make sure that
They drop it into a JV and then, yeah.
Let's touch on the delinquency rate, right? So, I read somewhere, I think it might be one of your articles, where delinquency rate is really getting up there for the non-QM, especially in this quarter, right? So I think I read somewhere, maybe it was an MBA study, where closing seconds and HELOCs have the highest delinquency, followed by non-QM. And then Fannie and Freddie has a very clean portfolio still, right? It's not that many loans. So on the NPL sales, which we get involved in for both Fannie and Freddie, my firms, I see, very little product. So Genie is a separate story, but I do you follow the delinquency rates and how it affects the non-QM market?
Yeah. I mean, I don't think it hasn't really affected the market now. The one thing I've noticed more so in the last year is that there are delinquent loans going into deals. So they're delinquent on day one, on the closing of a securitization. It'll be, 1%. Maybe I've seen as high as 2 to 3% delinquent of the loans in the deal on the day one are delinquent, which I thought always struck me as kind of odd. You never used to see that, because
Yeah,
I think people were early on non-QM, people were concerned about how the structured buyers, so the AAA buyers, AA buyers, how those folks were going to perceive the platform and the franchise, right? Because there were so many, it was early on, so they were very, very reluctant to put anything that smelled funny into a deal. Nowadays, it's more of a balanced market, I guess. The number of buyers and sellers in the structured products, non-QM arena, it's more balanced, so that the issuers hasn't hurt them, right? They tested the waters and it hasn't hurt their spreads. So why not do it? Because the alternative is you go out and you sell those loans at 90 cents on the dollar. Why would you do that? Put them into a deal and you cross your fingers. But the fact of the matter is, if you look at the Kroll report, the losses in non-QM, despite the delinquencies have been coming up a little bit recently, but losses have been minuscule, 3 basis points or something like that. That's a great piece if you can get your hands in that Kroll non-QM, they went back 15 years and they looked at 475,000 loans over a 15-year time period, and they break it out. It's a, I don't know, it's 50, 60 page report. They break it out every different which way you'd want to see. And they look at delinquency rates on, broken out by all those different aspects, all those different attributes. But it's like, so despite the fact that delinquencies are creeping up a little bit, and I think probably it's probably more debt service than the bank statement and other products. So, the overall losses they're like 3 basis points right now, which, the best years, even the First Republic, which was probably one of the best all-time residential lenders, their delinquencies were 2 to 3 basis points a year. I mean, the losses were 2 to 3 basis points a year. And that was one of the best lending franchises ever, in my opinion. And right now, non-QM is about running where First Republic was. So think about that for a minute. Now, the HPA, right, home prices have gone up a lot since COVID. That's helped significantly because, the average LTV in a non-QM loan is about 70%. So everyone's got significant amount of equity in their properties. And, even if properties now are only going up, certainly the market has cooled off since COVID, no question about that. So we're not doing 20% a year. Now we're probably only doing 2% a year, but still it's creeping up. Supply, and for the most part, supply around the country is still pretty low, pretty diminished. There's pockets here and there where it's come up, but right down to maybe around Boca and condominiums in Boca, there's probably a lot more of those since that collapse. But by and large, around the country, the supply is still pretty limited. So, you still have positive HPA. So the losses, losses on non-QM are playing the macro trend, and they're going along. But still, the average LTV is 70%, which is pretty good, right? If in jumbo, in prime jumbo deals, they're probably a little bit lower than that, but not significantly lower. You see a discrepancy in the FICOs, right? In non-QM, you'll see a 735 average FICO. In prime jumbo, you see a 775. But the LTVs are very similar. So yeah, the delinquencies have gone up a little bit, but the losses are de minimis. And the debt service coverage, I think that's where you're going to see if there's going to be a problem in non-QM, it's going to be debt service. There's fraud in debt service coverage loans. That is known. There's been some discussions about that recently. There's always been occupancy fraud in debt service coverage loans. So if you want to buy a house, and you can't qualify for it, you can say, well, I'm going to buy it and rent it out. And then after you close, you decide, oh, well, I'm going to move in. Right. So that happens. That's been going on for
very typical thing. I mean, it's right and left.
Yeah.
Right. And in fact, I hear stories that brokers are telling people what to do to qualify.
Yeah, it could be.
Yeah.
Could be. Yeah. Mortgage brokers, they just want the loan to close down.
Commission. They want the commission.
Yeah. Exactly.
Yeah. So,
yeah, it's a little sketchy, the fact that it's 80%, 85% mortgage brokers, because they'll be gone tomorrow and open up another shop, and you'll never, putting a loan back to a mortgage broker is like trying to shoot a ghost. It's never going to happen. So, anyway, so that's one thing about non-QM that's a little bit troubling is the sourcing. But anyway, so debt service is definitely seeing fraud, and recently there was a story about a large fraud in debt service coverage. One borrower apparently cooked the books. He cooked valuations on about 700 properties, and did cash outs on all of them, and then mailed them the keys. So that's in the market. There's I don't really know who owns those loans now. Nobody wants to talk about it very much. There's been a little bit of press about it, but it hasn't gotten a lot of.
If you have that article, can you send it to me? I'd love to share to my audience, but
I think it was an asset-backed alert.
Okay.
So I don't have it, but I've heard about it.
Well, I have a lot of issues there. It's interesting because my firms are doing the fraud check, so it would be interesting to see what we're doing from that perspective, and how would we detect the fraud and spot it and report it.
Well,
So
it's hard to if somebody has figured out a way to get properties in one neighborhood elevated, let's say, $300,000 properties, they get them valued at 600,000 for, massaging the appraisers or whatever they're doing. And then, they take 100 homes in a neighborhood and they simultaneously do cash outs on all of them. And they go to 6 different mortgage brokers. The problem is no, the issuers on that list, they don't coordinate. They don't know. They don't know that, each one of them have got 50 loans. They don't there's no communication. But in fact, if they did communicate with each other, and I've talked to them about it and nobody wants to do it, but if they communicate with each other, I came up with some kind of an exclusionary list like the GSEs have, right? Freddie Mac's got an exclusionary list that if there's appraisers that they will never allow on a loan.
yeah,
I think
blacklist.
the same thing should happen in IQM because obviously there's problems out there that the industry has, collectively should coordinate and figure out, who the bad guys are out there because, it can happen. And it's,
What's interesting is when we do, one of my firms is a TPR firm, third party diligence, and we are AI based, right? So the only AI based TPR firm called One Diligence, rated by all rating agencies,
what's
and
it called?
One Diligence.
One diligence.
Yeah. So again, you'll find this on the list of all the rating agencies. But what's interesting was uh, every client, every lender that we work with, they have their own blacklist. So it's not coordinated, right? It's something, yeah. So it's a configuration file for us. Well, who's on your blacklist? We'll load it and make sure we never see those people again. But it sounds like it's a centralized database or blockchain type of approach, where it's everybody's using the same lookup for like OFAC, right? To have a generic blacklist,
Yeah.
and have people there, and this would be great for the industry as well. But from the perspective of trading itself, right? So you have the platform, you own the platform for non-QM trading, and I think you're going to have a very unique view of the volume for the non-QM with respect to time, right? Pre-COVID, post-COVID, now. What do you see on the market, and what are the common pitfalls when people trade non-QMs as whole loans? And I guess there's a place for the MSR trading in the case of Annaly or somebody else, right?
Yeah, I've never seen an MSR, a non-QM MSR pool. It's interesting. Agency MSR pools you see out and about, and they're humongous.
Yeah.
But I've never seen a non-QM MSR pool. It's interesting. Anyway, but volume, the one thing that's hard to quantify is how much are the insurance companies buying. And my guess is doing some research earlier today. I did some a couple months ago. I've got some data from broker dealers and whatnot, putting it together. It's hard to pull it all together, but I think they're probably taking about a third of the market. So I think in 2025 we're going to see a non-QM, which I'm defining non-QM as traditional non-QM plus debt service coverage. Forget the
They,
stuff.
Dave, one more thing. The insurance companies you're referring to is MetLife, Prudential, New York Life, right? Those are the insurance companies that you're referring to,
Yeah,
right?
yeah,
Okay, got it.
yeah. So, but more so now you've got the Blackstones, the BlackRocks, Apollos that have started up insurance vehicles, and they're putting the loans in them. So the majority of the buying, I think, is from those folks. But anyway, so I think in 2025, my guess is we're going to see about 110 billion of non-QM. So that excludes that AUS stuff. Now the AUS will be another, I don't know, the AUS will be 12 billion, something like that. So in the grand scheme, it's not, like I said, people that are selling non-owner agents, non-owner loans to Fannie Mae are a little crazy because they should be selling them away to the private issuers. So maybe that will grow more because again, mortgage bankers are trying to, get a healthier P&L for the second half of the year. They're always looking to do that. So maybe that AUS market will grow a little bit more, but I think there'll be like 110 billion of you know regular non-QM plus debt service this year. So I think about a third of that's going to go to the life companies, and 2/3 of that will end up in securitizations. So securitizations will be 75 maybe to 80 billion. And the rest will be going into the life companies.
Interesting. Okay. And now how would that volume compare to closed-end seconds and HELOCs? Do you have a comparison? Is closed-end seconds still smaller, much smaller than?
Tiny. Yeah, tiny. It's this is going to sound stupid, but I don't even pay attention to to closed end seconds. I mean, there's a handful of people that only play in closed end seconds and HELOCs,
Yeah.
but it's a very, very small market. It's a very, very small market.
What attracted me to that market, and looking at that market is the growth rate, right? I think it's the highest growth rate for the mortgage segments. The closed-end seconds, I think it's 18% year over year. Then you have and you have newcomers like Avon Financial, Figure, SpringEQ, and others,
Yeah.
which are just generating, mortgage machines
Yeah.
in huge volumes. And we have some of those folks as clients, and things that they're generating is phenomenal. So they're almost fully digital platforms. That's what makes me sort of pay attention to those, because it affects how we underwrite the loan, which is not standard way. Everything is different. But at the same time, close the second HELOCs are growing fast, and certainly non-QM has a sub 10% growth. I think year over year, right? Or
No, 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 no. So in the first half of 2024
yeah.
versus the first half of 2025, the growth rate in non-QM issuance was 64%.
Oh wow.
Yeah,
Okay.
64%. So you're talking about an additional from 23 billion to 37 billion. So that's in real money.
Yeah. No wonder everybody's playing in that market. Okay.
Yeah. So, and this year, I think it's going to grow again. That's what I'm saying. We should do probably 110 billion this year in non-QM.
Well, all right. So plenty of growth space. And with Powell not barging on the rates, right? He's keeping the rates steady for longer based on the employment data, and based on the BBB bill, I think that the employment will still keep going up, right? So there's no incentive to cut, right?
I don't think he's going to move. Yeah, eventually, but he wants to be very, very sure, 100% sure that the tariffs aren't going to push inflation up. But, I think he's going to prove, once again, he's going to prove to be a little late to the party.
Yeah, but we have to adjust, right?
Well,
And
yeah, I don't think it, honestly, I don't think it really matters
yeah,
in the market. I mean, it does for the, generic mortgage bankers out there that are trying to do agency only loans. If that's the only thing that they're doing at this point, then, they'll probably survive. If they've survived this far after the rate hikes in 22, then they probably will be okay. But they're, it's a crazy business where they make tons of money in 2020, 2021. Your agency mortgage bankers made boatloads of money, and now they're not making any money. So it's a feast or famine business, and that's why non-QM and closed-end seconds and HELOCs are the volume is up so much because people are trying to figure out a way to make some more money.
yeah.
So it's too much capacity in the system, I guess.
So that's an advice to everybody who is in the mortgage broker or mortgage lending industry. If you're doing just agency, you should really start looking into non-QM and closed-end seconds.
But if you haven't done it by now, you're probably never going to do it.
There you go. All right, but don't give up. Still look at it. Yeah.
Mike, I mean, there's more people. I talk to people all the time. People call me, asking me about stuff, about advice and whatever. I'm advising a couple different companies. I got a call last week. I talked to some guys. They're mortgage brokers right now. They want to start banking because what they're leaving on the table is a significant amount of money. They're probably leaving 2 points on the table for every loan that they originate. So they're going to get, I told them where to go to get warehouse lines. I told them, I walked them through the whole process of what to do to get set up. So that's the second call I've had this in the last 30 days like that from mortgage brokers that want to become bankers because they want to make more money. And one thing I know we're jumping around here. I don't know how we're doing on time, but
We got some 10 to 15 minutes.
okay. Yeah, gain on sale margins. I confirmed this with some folks today. They're probably on non-QM. So if you originate, you close a loan, your XYZ mortgage, right? You're if you're going to sell it. So if you're a mortgage banker, you're able to close the loan with your own funds on your own warehouse line and sell it. There's two ways to sell it: flow or bulk. And the smaller guys all sell flow. And at some point, you get to a point where you can start to put out bulks. And the pickup is probably 50 to 75 basis points. If you're able to aggregate 20 million of loans and put it out in a bulk pool and sell it out of the market, you can probably pick up at least a half a point. So it's going to take you some time. If you're doing significant volume, it's not going to take you long to do it. If you do 200 million a month, 250 million a month, you can do that a couple times a month and pick up a nice, incremental income. If you're not, you're definitely leaving money on the table. So one thing that I'm seeing going on in NonQM is that people going from more flow to bulk. But at times when there's disruptions in the market, which happens on a regular basis for a variety of reasons, there are people you have to be able to sell flow because the bulk market can sometimes just evaporate overnight.
Yeah. Can people contact you for any advice after this podcast? Okay, perfect.
Yeah. I help people all the time. It's just I don't know. People help me, so I've helped. In my past, people have helped me, so I do the same thing.
Yeah, paying forward. Let's in the final couple of minutes that we have left, let's touch on Fannie and Freddie exit, right? So, do you monitor what's happening, and sort of time frame on when we should expect the exit from GSCs and government sponsorship? I can tell you my opinion, but I would be interested to hear yours.
It's hard to predict anything coming out of the White House. They get, it's a tweet at 3 a.m. He keeps everybody guessing. So, but I think the one thing I think is interesting is that Fannie and Freddie, they compete with each other. Essentially, there's nothing unique about one. Maybe multifamily, right? One of them does a little bit more, but they compete in multifamily too, and they compete in residential. I don't know why. 50 years ago, when they were getting going, they came from different places. They serve different constituencies. Nowadays, they're both the same, and they're ultimately going after the same lenders and same borrowers. I don't know why both of them need to exist. I think if you could probably save if they were put together, it probably save $2 to $3 billion a year in overhead.
Easy.
Maybe $4 or $5 billion a year and not hurt the market at all. But, I don't think that's ever going to happen. But in terms of timing of when they're going to start, I look at the stock. I look at Fannie Mae stock, and it's been, it's gone from $2, $3 up to $10, $9. So everyone's expecting that to come out anytime. But the government owns 80%, right, of Fannie Mae right now, I believe. I think that's the number.
Yeah, but it's not just that, right? It's the I was a part of the Rick Shargus CEO roundtable in Washington next to White House, and Mark Calabrio announced his plans at that conference. It's a very small, no media conference. You're not allowed to record anything, but it's the way for CEOs in the mortgage and finance market to talk to the government officials. You had Julia Gordon there. You had former CFPB guys. And he disclosed that Trump is looking at 27, 28 as a time frame for Fannie Freddie exit to work through some of the mechanical things, but it also depends on the midterm elections, right? So midterm elections can really shut it down if that happens, and it'll switch from Republican to Democrat, then probably he'll put the Fannie Freddie plans on ice. But other than that, it's going to be a sovereign fund repurchase and of stock, and then sort of dilution of stock to get this private from the governments, and they'll recap sort of the money received and pay for some of the Trump plans on the BBB and other sort of deficit type of increases.
Yeah, because
But that's yeah,
it's definitely paying a nice dividend, right, to the treasury. No question
right.
about that. Yeah.
Yeah, I mean they're making tons of money, and but they're not as competitive as UWM or Rocket, right? So they really have to um, you know, tighten their belts and make sure that they're running as the private company rather than a government sponsored, do whatever you want type of company. So
Yeah.
they've been getting there. A lot of layoffs from what I hear from Fannie and Freddie.
Oh, yeah?
So yeah, they were getting leaner. And at the same time, they're experimenting with the AI tech. I'm a part of it as well, right? So the title waivers, the AOLs. So it's still in experimental stages, but they're
Mm.
trying, right? They're trying to find that niche that will, um, make sure that people paying extra, like quarter of a point, to go and securitize through Fannie and Freddie have their money worth, right? Either they save on the origination cost, that amount, or there's sort of a fast track to securitization and approval. But certainly it's an interesting topic, and I always listen to Rick Sharga. He's great with that, or Chris Whalen. He's also pretty knowledgeable in that.
Mhm.
Yeah, so I'm sure you know Chris.
Yeah,
There,
I met yeah, I was on a panel. Was I on a panel with him? I was at some event and he was the next panel or something. But yeah, he's an interesting guy.
love him. So in a couple of minutes, David, how can people find you? Where do they go? Anybody who is interested in that topic, any final words that you have for the audience?
Yeah, I mean, whole loans. I own wholeloans.com. So if you go to wholeloans.com, you can see my contact info there. Um, and the other thing I've been working on recently is this RWL trade, which is what I'm trying to do is develop a kind of a very low tech, simple, old school type trading platform for non-QM to bring in insurance companies are primarily what I'm trying to get to the table as kind of sponsors for the platform, and then let um, people that are selling bulks post pools to the platform, and I'll sit on top of it and make sure the stuff is there's no junk getting posted into the site, and have the insurance companies bid against each other for the pools. So it's taken longer than I thought it was going to take. Obviously, everything always does, but that's something that I'm working on. But we'll see how that goes. But I think it's a kind of like the collective intel of the lending base. I think that's probably something that would work well for a lot of originators at times, especially times when liquidity is evaporating for some reason, or there's some kind of a credit event. Um, and I think it's a way for insurance companies that are now more interested, besides, asset managers and insurance companies are more interested in, again, figuring out ways to get the loans. So I think it works for both sides. So I think over time, it's going to take a little bit of time, but I think over time it'll work out. So anyway, but Whole Loans is my primary website. And, I post most of the stuff I put on LinkedIn. I also post, I have a blog, right? So there's a blog that you can go to, and most of those postings are there.
Understood. All right, David, I wanted to really thank you for your time. Great chat. I'm hoping that it generated a lot of awareness on the non-QM space, DSCR space. If you're not playing in that market, you should really start playing as soon as possible. At least learn what it's about, how to sell, who is your potential clients. It's growing significantly since COVID, and we are playing as well. All my free companies are playing in those markets, so I'm pretty excited about it. I see only growth, just like David does.
Yeah.
So once again, David, thanks for your time today.
Thank you very much. Take care.
Take care.
All right. See ya.